Holy schmoly, ladies and gentlemen. Markets sold off into the close. In fact, it was actually one of the worst bounces I have seen in a long time. Like, this tops the charts, okay? Because let's consider this for a moment. You've sold off a lot, right? We've had a lot of fear out there. The fear and greed index was at like 10 at one point yesterday. The VIX hit 65, okay? The RSI and the S&P hit 30. That's typically when you expect to get a bounce. I expected a bounce today. I did. But more like a 3% bounce. Maybe a solid 2.5% bounce. At one point today, we were up 2%. And you gave it almost all back. If you include the move here in after hours, where you're down 1/3 of 1%, you're actually only up like 1/2 of 1% today. And considering all of the fear, pain, carnage we have seen in markets, the VIX spiking to 65, I expected a bounce was going to be much larger than what we got today. This is a really bad sign for the bulls, okay? This is like the worst sign for the bulls. So here in this video, I will put this into perspective, what's going on, my expectations, and what will happen next. Keep in mind, I am not a fortune teller. I am not a financial planner. I'm not a financial advisor, okay? I called this out perfectly, though. So it might seem like I'm just always correct sometimes. Trust me, I'm not. If you've been here a long time, you know I'm not. Sometimes we're spot on. On the X account, I pinned this on July 9th. Almost a month ago. It says 10% SPY correction is coming within the next 6 weeks. That was on July 9th, guys. That was about 4 or 5 days before a new all-time high. So markets went higher after this for a couple of days. And then it has just worked out along my expectations, right? This has went exactly as I expected it would. Okay? So what I'm going to say here in this video, it's not guaranteed, but I feel very strongly about this information. Okay? This is actively what I am doing. And yes, if you were wondering, we profited a lot in the trading community based on that call. Got some TLT calls, had some Russell puts, Coinbase puts. Wow, that was ridiculous. What was that? Yesterday morning? Those things were thousands of percents. The TLTs were almost 1,000% as well. The Russells were thousands of percents also. But doesn't matter. If you guys want to join, check out the link down below in the description of this video. This is much more pressing than that. Forget that. You get the information for free here in these videos as long as you are subscribed and hit the like button. I just appreciate that because it's free 99. Again, back to what I said. This was the most pathetic bounce I have seen in a very long time. Probably ever. Okay? One thing that really sticks out to me is you got rejected at this 100-day moving average. Like straight up rejected. I figured after maybe a 2-3% bounce, it's possible we could trade between the 100 and the 50-day moving average in here. But that's not going to happen. Now, let me show you something pretty interesting. David Marlin shares this research from Goldman Sachs trading desk. They say hedge funds bought the panic dip yesterday. U.S. stocks saw their largest one-day net buying in 5 months, according to Goldman Sachs prime desk or prime broker. 8 of 11 sectors were net bought, led by tech and defensives. Now, you would think this would be great, right? You would think hedge funds going out and buying is fantastic news. Yes and no, right? It does signal most of the selling from the Japanese meltdown that we've seen is likely over with, okay? That's true. It does signal that to me. But you know what it does not signal? It does not signal any part of this sell-off has been a growth scare. Legendary analyst at this point, Tom Lee, says this is just a growth scare. Ritz Holds Capital Management says this is just a growth scare. And basically, like everyone on CNBC says, this is just a growth scare. It's not. People are buying. People do not buy during growth scares when federal funds rates are 5.5% and we may or may not go into a recession. Hedge funds just don't buy like crazy during that environment, right? So the fact that you've seen a lot of buying yesterday, this buy the dip mentality, means there's not a lot of growth. Fear priced into this market. Ain't that right, Emerson? Ain't that right? Yeah, that's what I thought too, dude. It's funny. Yeah. Now, as I've said many, many times here in this video, or not in this video, but in other videos now, we've priced in most of this Japanese meltdown, most likely. JP Morgan says it's about halfway done. So there could be a little bit more. I think that could easily take us to retest the 200-day moving average at about 497. From peak to trough, that would be downside of about 12%. That is the average correction you see during an election year. It's 12%. So a test of the 200-day moving average, that could happen based on Japan. That could happen based on a potential strike from Iran on Israel, potentially here in just the next couple of hours. That can happen just for those reasons. But where you get 20, 30, 40% downside from here, maybe even more than that, right? In a more doomsday scenario for the economy, is economic activity slowing down, right? I don't think like any of this really selling at this point, I mean, in light of the Japanese meltdown that we are seeing, has anything to do with growth. Honestly, I don't think like any of this has to do with growth. I'm just going to be honest with you. Now Wall Street's fearful over a recession. Bullshit. That's not true, right? It is the trade here of borrowing in Japanese yen, buying assets in other currencies and other markets, and then getting margin called and having to sell all those securities. That's what has caused the downside, right? It's not growth concerns at this point. Wall Street wouldn't be buying the dip if it was growth concerns. Now, who's right? The hedge funds that are buying the dip or not? Time will tell. If the economy weakens, those hedge funds are going to be looking stupid if they're buying the dip here. But I did want to see a larger bounce. Again, I'll circle back to that. I think what we got today was disappointing from the bulls' perspective, and likely does mean a retest of lower lows is coming. Okay. Now, here in after hours, the S&P is down 1/3%. SMCI is down almost 8%. Apparently, Wall Street doesn't love stock splits anymore. And that's clearly a joke because Wall Street loves stock splits. They announced a 10-for-1 stock split. Okay. It'll start trading on October 1st. Now, SMCI is likely down simply because this quarter earnings came in at $6.25 versus $8.07 expected, even though revenue beat marginally. These were basically in-line numbers with earnings that came in a little bit worse than expected. Now, you also have next quarter guidance for revenues that came in between 6 and 7 billion, beating Wall Street's estimate of 5.46 billion. So that was really good. EPS is expected $5.59 to $8.27, or $7.48 for the midpoint. That was compared to the consensus estimate of $7.58. So even on the midpoint, you're lower than expected for next quarter EPS. On the low side of $5.59, you're like 25% lower than expected. And you can see some pretty aggressive downside moves on some of your big tech stocks here in after hours. I don't know what his problem is today, so there's not much I can do about that. Single dad. So if it bothers you, well, that is what it is. Nvidia is up about 1/3%. Apple is down almost 1% in after hours. Meta is down 0.5%. Google is down 0.65%. Microsoft is down almost 0.5%. And same goes for Amazon. You're seeing some pretty large declines in your mega cap tech here in after hours. Look at Tesla, down 1.5% in after hours. That's quite a big drop for after hours. So again, just to kind of reiterate this, the only thing that matters, number one, is the economy. Yes, the Japan carry trade is going to have the short-term negative selling pressure on markets. And in fact, I think that's the whole reason markets have been falling to begin with. This Japan carryover trade dissolving has been happening for a long time. It just didn't become front and center until like 2 days ago, right? It's been happening for weeks. We just didn't hear about it until it really, shit started hitting the fan. Okay, this is no growth scare. It's bad, guys. It's bad that Wall Street really thinks this is a growth scare. Like, I don't know. That's not a very educated assessment there. Just judging off of what we're actually seeing. It's not a growth scare, okay? This is not a growth scare. And that's, I guess, the problem with Wall Street is, they're so narrow-minded. It's ridiculous, right? Growth scares are the reason for corrections most of the time, but not this time. We haven't even got to the growth scare yet. Now, does that mean we just need to continue to fall? Of course not, right? I think a test of your 200-day moving average would be a good level for this Japan situation to kind of level out. Wouldn't surprise me if markets could actually bounce back to where we are now, right? Say you fall to the 200-day moving average, bounce back up here, kind of trade in this range. That's basically what I'm expecting. Now, why I say the only thing that matters is the economy is because if we do enter an actual growth scare, then you get larger substantial downside because you're not pricing in a growth scare. We still have sky high expectations for 2025 earnings. No growth scare there. Estimates haven't changed, right? How do you get a growth scare if estimates don't change for growth? Make that make sense. Please, someone down below in the comment section. And you're still seeing, a lot of stocks, especially your big tech, still trading at very, I want to say elevated valuations, but it's relative to their growth rates, right? Subject to their own growth rates, their PE multiples are insane, right? A lot of these companies are growing revenue at like 5% a year. Yeah, sure, they're growing profitability a little bit more, but we'll see how long that can last. Topic really for another video. The economy, the labor market, that's the only thing that really matters to this market longer term, right? In terms of large downside, 20, 30, 40% crash, that's what matters. That's how we get there, okay? In the short term, it's not about the growth scare. It's about Middle East. It's about this Japan carry trade. That's what is affecting markets. And a little bit here in after hours, obviously based on SMCI earnings. SMCI is down 11% here in after hours. And depending on how this thing goes, it could definitely shake a few things up. But the next biggest event we have really to look forward to in terms of markets, and growth scare, or I guess you could say growth scare, but the labor market cracking is initial jobless claims. So just yesterday we were pricing in 250,000 initial jobless claims for this upcoming Thursday. Now we're pricing in 240,000. Last week you came in at 249,000. So initial jobless claims are one of the first kind of leading indicators to what's happening in the labor market. If we start to see jobless claims go like 300,000 or higher than that, then that is a pretty clear sign that there's substantial weakening in the labor market. Right now, it's just been kind of bad, not terrible, but also not great. So Wall Street's going to pay attention to that. Initial or continuing jobless claims as well, expected to actually fall a little bit. And that will be on Thursday. You got some Fed speakers on Friday. not too much. Some data coming out for Canada. I should mention tomorrow you have a 10-year bond auction and consumer credit change. But really, besides Thursday, there's not anything else as far as data for this week. And I think the bounce is over, okay? I'm just going to be honest with you. That was the most, again, pathetic bounce that I've ever seen in my entire life. After the VIX hit 65 yesterday, you would expect if we get a bounce, like you're going to bounce a lot, okay? You're going to bounce like 3%. No. We bounce 1%, closer to a half of 1% if you include the after hours move here. That's weak. That's bad, okay? Yeah, and I think that's a very good sign that the selling is not over with. Not over with at all. So that's kind of what's going on, my perspective on markets. Again, I think you'll likely hit that 200-day moving average, bounce up a little bit, shop around, in a very volatile way over the next coming, let's call it months, right? Next 3, 6, 12 months. The growth scare, the labor market cracking, if that's what we want to call it, is the thing that really matters as far as do we go into a bear market or not. Just hitting the 200-day moving average, it's going to feel like crap, but that's the average drawdown during an election year. Like, that's typical, right? That's like what we should historically expect. So I don't think that's too crazy. And I think that happens because of Middle East tensions. And I think that happens because of this Japan carryover trade that is, starting to dissolve. I still think cash is king right now. And, in a way, if you hold a lot of cash, let's say your brokerage account's 50% cash, you're pretty well hedged just in cash. Yes, the other 50% of your portfolio that is in stocks can go down in value, but if you're 50% in cash, that's a pretty good way to hedge in and of itself. So I think the more cash you have, the less hedging actually makes sense, because then you're just trading at this point. And I think you're going to have a great opportunity to buy stocks at cheaper prices than we have today, but you just want to have that cash available. And I do think right now, cash is clearly king. But if you are trading our markets, I do think you want to be in and out pretty quickly. I don't think you want to hold trades overnight. This is not a swing traders kind of market. When you're going to get this choppy volatility, that's a option selling market more than it is an option buying market. It can be great to buy options during this market and trade that way, but you have to be nimble. You have to be in and out. You have to cut losses quickly and really follow your own plan, or you will get wiped out in this kind of market. So be very careful. And I think the best thing for everyone to do is just sit and wait for lower prices, whether that is Tesla, whether that is other stocks. I think you're going to get much better prices on these stocks. I think when the growth fear comes, when the labor market does start to weaken further, when the economy does weaken further, Tesla's going to fall more. It's going to fall under $200 per share pretty substantially. I think Apple, I think all of your big tech, your AI stocks, if you will, they're all going to fall big time, like big time. And that's coming. It's just not here yet. You have a couple of months potentially to prepare for this, but I think you want to prepare for this right now. Nonetheless, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.